This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Forex Report with Scott Norse.
Good afternoon, traders. I'm Scott Norse, wrapping up the week with your Forex Report. Today is Friday, April 13th, 2007. The greenback fell to new multi-year lows against several currencies this week as traders struggle to find reasons to buy the U.S. currency. Data has been far from supportive in recent weeks and months, suggesting the economy may not bounce back as quickly as some economists had expected. The IMF on Wednesday officially lowered its 2007 growth forecast to 2.2% from 2.9%, pointing at a deeper slump in the housing market as the primary reason for change in its estimate. The fund added that the global economy is now more independent of the U.S. and should be able to weather a slowdown much better than it has in the past. Adding insult to injury, the IMF managing director said yesterday that he sees room for the U.S. dollar to weaken further. This is really a 1-2 punch for the dollar and comes just ahead of a G7 meeting beginning today in Washington. The calendar was very bare this week, with only U.S. numbers coming out this morning. Other important news and events over the last few days include an ECB meeting yesterday morning. While the central bank left rates unchanged, ECB head Trichet did signal that a hike should be expected in June. The BOJ also met this week to discuss interest rates, but are not quite as hawkish as most other central banks. Japanese policymakers are expected to do very little in the rate hiking arena this year, which has pushed the yen to new record lows against the euro and Aussie. Today's U.S. lineup included the trade balance, PPI, and Michigan confidence. However, the market is looking much bigger picture at this point, and the mixed results had very little influence over prices. Now to the big picture. The G7 meeting could play a major role in the dollar's performance if traders perceive the communique as an invitation to sell the currency further. We saw this reaction a year ago when the statement called for appreciation in Asian currencies, which became a green light to sell the dollar. It is no secret that finance officials from many of the world's largest economies agree that dollar weakness would help curb global imbalances. However, these same officials warn against volatile and excessive moves in exchange rates. The bottom line is that the U.S. currency has really fallen so far out of favor that any hint of a call for weakness could result in a bloodbath in the weeks to come. The other big question is whether or not the meeting will focus some attention on yen carry trades, which have reached incredible levels. A few officials have suggested that they would address this issue at the meeting, while countries such as the U.S., UK, and Japan have shown no interest in doing so. The IMF this week promoted further yen declines by saying that the carry trade was not as destabilizing as many believed and see no reason to intervene. If the G7 statement emphasizes this lack of concern for the positions, we could see the Japanese currency fall to unimaginable levels. Until next week, have a wonderful weekend and take care.